In 24 hours, this news will stun the world. I'm Steve Van Metre. The bar this week has set high that could cause the machines to unleash terror, crushing your portfolio. What's Wall Street hiding? Stay tuned. Now, let's over to Bloomberg, where he picked today's story up with a headline, is Big Tech's earnings problem as estimates may be way too high. And this is something that a lot of retail investors don't realize because they've been aggressively buying the dip. Because during a bull market, that's the move you want to make. Every time there's a pullback in price, you want to buy. But right now, the analysts have set the bar high. As we've talked about before, they want this market to come down. And based on what you're about to see, we could find the market plunging once again. And this week's quarterly results from Microsoft, Apple, Meta Platforms, and Amazon will land in a market obsessed with every twist of a trade war that's already wiped out $5.5 trillion from the S&P and could wipe out even more. AI concerns have taken a backseat to angst over the possibility of tariff-induced recession. Will safe havens like gold have become a trade du jour for investors too rattled to buy stocks on the cheap? And this is kind of good news for some of these tech companies because we already know they've been spending massive amounts of money on AI, and the reality is they have little to show in terms of return. So the trade war is giving them kind of a smoke screen here, but I want to know from you, are you buying stocks in this market? Are you running to safe havens like gold? Weigh in the comments below. I want to know what you're doing and why. Because even with all the uncertainty, Wall Street isn't giving the company's estimates much wiggle room. Analysts expect the so-called Magnificent Seven, which includes Google parent Alphabet, Tesla, and Nvidia, to deliver an average of 15% profit growth in 2025, a forecast that's barely budged since the start of March, despite the flare-up in trade tensions. So normally when analysts want the market to go up, they set the bar low, and they know that companies are going to hop right over it, and it's going to drive prices higher. But when analysts and the companies behind them want stock prices to go down, likely because they're short the market, well, what they do is they set the bar high, they keep it high until companies miss, and then next thing you know, pain starts to roll right across the markets. And we start to look at machine positioning, we can see exactly what the danger sign is. We talked about this on Sunday's show. The CTAs are positioned right now to be major sellers. We saw them cross a threshold on Thursday and were forced to short cover, and many hoped the S&P would continue to rally and force them to be even bigger buyers at the next line. But right now we're seeing a reversal, and with earnings setting to kick off today and go crazy starting tomorrow, well, what it suggests is we could see a massive reversal here, and this machine buying could turn into massive selling. And we talked about on Sunday that the liquidity of the market is still very thin. In a normal market, you want to see over 8 million shares in terms of liquidity. Right now, we're trading at just over 4 million. So the risk is we could see an all-out plunge. But when we talk about corporate profits after tax, the notion here that we could see a big miss starting this week is very high, because when you look at the relationship between corporate profits and average weekly hours of production of non-supervisory employees, it starts to make sense that if people don't have the income to spend, companies can't generate profit. And you see it clearly in this chart as we note that corporate profits were decelerating in the late 1980s. At the same time, hours worked were falling. Of course, we went right into the 91 recession, but you can see in 1994, we had what looked like a soft landing. Hours worked declined a bit, profit growth slowed. We see it happen again going into the dot-com bubble very clearly in the midst of the global financial crisis. It happens once again around 2013 to 2014. We see it again in 2018, and now we're facing the same scenario because analysts want to see companies miss, but based on the fact that hours worked have already been declining, the odds that profits and earnings are going to miss and head to the downside is extremely high here. And again, what we're setting up is another move down in the market at a time when a lot of people have been aggressively buying this. But keep in mind, there's a reason why. We've heard from the pros, the fund managers, why they're selling this market here and they aggressively want out has a lot to do with what's coming this week. But many think that rising consumer prices are a boom for corporate profits, but not always. And yes, there are times they are, but let's go back and see what happens going into recessions. As you can see here in the late 80s, the consumer price index was rising, but why did profits fall? Well, it was very simple, because incomes weren't keeping pace, so consumers couldn't keep spending, and that hit the bottom line of companies. We see that happen again going into the dot-com bubble. Again, rising prices led to a deceleration and contraction in profits. Happened again in the global financial crisis because energy prices sapped consumer budgets, again, sent corporate profits contracting. And now, due to the tariffs, we know companies aren't going to benefit from the tariffs because it's a tax. In that case, we know prices are going up, incomes aren't, and that means profits likely to go down, which is why we're going to see companies pull their guidance, because they don't want you to know that what's happening right now is only likely to get worse. I'm going to show you that here in a moment, because that raises the stakes for the four mega caps reporting this week, which collectively have nearly a 20% weighting in the S&P 500. And when you factor machine positioning, which could go back into a deep short position, you can see why stocks could plunge in big time this week. Traders are unlikely to forgive earnings shortfalls in an already fearful market climate, despite steep declines in the stock's share prices and improved valuations. And it's everything, again, to do with analysts. They want this market to go down. And this is what Wall Street doesn't want you to know. And that's why I want you to see it, because there could be a lot of chaos this week. It's going to impact your portfolio. And dire outlooks from the industry behemoths would also be poorly received, especially if they bolster fears of muted corporate spending ahead. And this is a problem because, again, we talk about these big mega cap companies that are spending massive amounts of money on AI, and they're likely to have little to show in return. They're going to use a trade war to kind of cover that up, but at some point, they're going to have to justify all that spending or see their stock price come crashing down. But just because the broad market may crash doesn't mean your trading account has to go down. We told our Momentum Timer Pro subscribers back on the 14th to buy GBTC or Bitcoin on the open. And sure enough, right here on this green candlestick. And how do we know it? Well, we saw the RSI and the MACD and other technical indicators rising along with the trend. And as of close of business on Friday, this trade is up 12%. My friends, you could join my subscribers in making big money trading momentum in this market. All you have to do is grab the links in the description below, use a coupon code for your free 30-day free trial, start trading momentum, and win big. Stay tuned to the end of the show for more information, because a deeper look comes during a 2-day stretch that starts with results from Meta and Microsoft on Wednesday. And while many executives have declined to predict how tariffs might impact their bottom lines out of fear their stock would tank, what we can see is that experts believe there's going to be a contraction in net income of about 7% in 2025 for the S&P, compared with the current consensus estimate of nearly a 12% growth rate. So again, I want you to see that the analysts are setting the bar high here, knowing that companies are likely to miss. This is going to send stocks down and eventually lead to retail capitulation. Because one thing we see in May, and we talked about this on Sunday's show, is a lot of retail investors sell this time of the year. Another key focus will be spending, as the four biggest spenders, Microsoft, Alphabet, Amazon, and Meta, are projected to pour roughly $300 billion into capital expenditures in their current fiscal years, with companies pledging to maintain that pace in 2025. What we've already seen from Microsoft is a sudden decision to pause work on some data centers, suggesting cloud computing providers may be reevaluating expenditures because they don't have the revenue to justify it. And again, if they don't, at some point, all this AI spend has to generate a profit, or else the stock price is going to get crushed. But JPMorgan says, forget all that. This could be a buyer's market. Let's take a look at why, because they're saying, look, this is technical in nature, not fundamental. As JPMorgan's trading desk turns tactically bullish, I want to know from you, are you bullish here or bearish? Or are you trading gold, Bitcoin, or something else? Again, weigh in the comments. Love to hear from you. Because while they think this rally could span multiple weeks, JPMorgan traders point out it's not an all clear for the markets. Unfortunately, we think they're still 1 to 2 months away from seeing the negative impact of the trade war on the real economy. We're going to talk about that in a moment, because it's significant what's going to start here in May. And that said, the hypothesized delay impact means that immediate macro data is likely to paint a picture of a still resilient economy, starting with a non-farm payroll on Friday. And that's one of the key things here, is the hard data does look like the economy is being resilient here. Meanwhile, the soft data is telling something about a different story. Now let's take a look at the soft survey data. Let's go back to 2023, because we see in green it plunged, but the hard data didn't. And next thing we know, the soft data turned around. And there are times as we get into March of 2024, the soft data plunged, the hard data rallied a bit, and then it came crashing down. And right now, the hard data is going up. The soft data is saying not a chance. The question is, what side of the market is right? And what JPMorgan's suggesting, as long as the hard data looks good, it doesn't matter what the soft data says, but there is going to be a point here the next month or two where everything falls apart, and we can already see why. As Trump's China tariff set to unleash supply drill on the U.S. economy, and here's a danger sign, my friends, this is set to now start here in May, and look at how bad this is going to be. And since the U.S. raised levies on China to 145% in early April, cargo shipments have plummeted, perhaps as much by 60%. The drastic reduction in goods from one of the largest U.S. trading partners hasn't even been felt by many Americans yet, but that's about to change. And so right now, as we look at the hard data, everybody says, look, the U.S. economy is strong and resilient. The soft data says not so fast, but now we're going to see the real effects of the trade war because it's going to show up and soon. And by the middle of May, thousands of companies, big and small, will be needing to replenish inventories, despite the fact that we heard recently from some companies saying we have 3 to 6 months of inventory. But what they have is old inventory. They don't have new stuff. They don't have what people want right now, and they don't have what people are going to want to buy in the months to come. And giant retailers such as Walmart and Target told Trump in a meeting last week that shoppers are likely to see empty shelves and higher prices. And what we see then is warning of what could be COVID-like shortages and significant layoffs in industries spanning trucking, logistics, and retail. And this is exactly what I've been warning about. And this is what the soft data is indicating. The demand is plunging, and at some point, demand for labor goes with it. And as soon as we see a big decline in imports, what you're going to see is a big increase in layoffs. And here's the evidence. If we look at the imports of goods into the United States in blue against average weekly hours of production and non-supervisory employees in red, and what we could see in the late 1980s, there was a deceleration in imports, led to an immediate cut in hours. You go right into recession. And we could see this happen going into the dot-com bubble as there was a massive deceleration in imports that led to an all-out contraction, and average hours went right down with it. We see the same thing going into the global financial crisis. We even see it in 2012 through 2014, happened again around 2016, happened right before the pandemic hit as we were headed into a globally synchronized recession. And now we're facing the same thing with imports set to crash and once again go negative on a year-over-year rate of change. What this means for many people in the retail and transportation industry, the hours are going to get cut if they're lucky, and then at worst case, they're going to see their job loss. Now, I want to know from you, are you already seeing signs of this? If you work in those industries, weigh in the comments below, because the number of ships heading to the U.S. is going to plunge as the volume of cargo is already down about 40% from this year's peak, setting the United States up for a recession. And when you tack on the fact that analysts already set the bar high on a lot of these tech companies, you can see why they want the market to go down. You can see why fund managers want out of this, as Bank of America recently said. We're paralyzed, said one toy maker, which supplies big retail customers such as Amazon and Walmart. He called tariffs a de facto embargo and said customers have been pausing orders so far, but he expects them to start canceling them if Chinese tariffs stay at this level for much longer. And that's a risk. Pausing orders is one thing because you're saying I'll buy it, but just not yet. If you cancel it, well, that means that layoffs start to hit and in a big way. It's also going to be a big financial hit that many companies will likely respond by cutting costs, including jobs, or taking on pricey debt. And the risk of supply problems morph into a credit crunch, as U.S. firms could find themselves at risk from tariffs, and then the economy more broadly if these leverage operations find credit less available because tariffs force them to operate with smaller margins. And this is a problem because, again, what we see is these companies need access to the credit markets. And if credit markets think that they're not going to get their money back, they're not going to lend them, or they're going to raise interest rates. And for a lot of these companies that run on very thin margins, they can't afford that. Again, could put some of them right out of business and trigger mass layoffs. But if there's any hope that this is going to end soon, well, what we're hearing from the White House right now suggests otherwise. As Bessent said, it's up to China to de-escalate in the trade war. We'll see where this goes, Bessent said. As I've recently said, I believe it's up to China to de-escalate because they sell 5 times more to us than we sell to them. So these 125% tariffs are unsustainable, or at least for them it is, and that's the hope. The Chinese exempting some goods from tariffs indicates they're interested in reducing tensions, adding that he has an escalation ladder in my back pocket and we're very anxious not to have to use it. Escalation could include embargo, he said, and that of course would be dangerous, but at current signs it looks like everything is working as inbound ships are actually plunging and set to drop even more. The risk here is this could lead to mass unemployment in the U.S., and if you think that will turn around very quickly if we make a deal, it's not likely. And that's the bet China's hoping on. If they can hang on and unemployment starts to skyrocket in the U.S., this trade war is going to come to an end and fast. Basent said the U.S. has put China to the side for now as it seeks trade deals between 15 to 17 other countries. He said he wouldn't be surprised if a trade deal with India is the first to be announced. And Basent also said that U.S. officials met with their Chinese counterparts during an IMF World Bank meeting in Washington, D.C. last week to talk about financial stability, but did not indicate that trade discussions came up during any talks. Because what happens when people start losing their job and quit spending? You get massive amounts of financial instability. And what does that start with? Well, it means people go into immediate delinquency by stopping making payments. Then they go into default. And so what I want you to see is the longer this trade war goes, the risk that the U.S. economy falls into an all-out financial crisis are extremely high. But at the same time, we're not seeing any resolution. And even Trump floats a new income tax cut in bid to ease tariff bites in a sign, once again, that this trade war is not going to be over anytime soon. We can hope that it will, but right now it doesn't appear based on what Trump and Basent are saying. When tariffs cut in, many people's income taxes will be substantially reduced, maybe even completely eliminated. Focus will be on people making less than $200,000 a year, Trump said on Truth Social. But the reality is, whether people are paying an income tax or they're paying what looks like a national sales tax or a consumption tax through tariffs, people are still paying taxes just in a different way. Despite the fact that if we do cut income taxes, the reality is what we're hearing from the White House right now is this trade war is not going to be over soon. Then the risk is, and what we're going to see during earnings season, if these companies start to miss, stocks are going to plunge. And if the trade war persists and unemployment starts to skyrocket, we're going to see the U.S. equity markets into an all-out bear market, one that could plunge our entire economy into a complete financial crisis. But even if that happens, doesn't mean you can't make money in these markets, because we put a buy signal out on GBTC or Bitcoin back on the 14th as of the close of business on Friday. Our Momentum Timer Pro subscribers are up over 12% on that trade. Here you can see the notes. Buy it open, upside target, that's already been breached. We're making a ton of money, and you can too. Now, how do we do this? Each and every day we look at the momentum or technical indicators, things like the RSI and the MACD, and we aggregate them together and run them across the broad equity, bond, currency, and commodity markets. And we look at momentum screens on a 1 day, 1 month, 3 month, and 6 month window. But momentum isn't enough, because in a downtrending market, you can go from oversold to oversold, and you can find yourself losing money. So what we do is we pair our momentum signals with the trend. When we see it coming out of oversold conditions with a rising trend line, well, that gives our traders the edge, and it can give you the edge too. You get the daily report, you get the tradable signals. I even give you my opinions on the best trades to take. You get risk control levels, a full tracking of all open trades in return, a weekly update. And here's the best part, you get a 30-day free trial. We want your first 30 days to be on me. All you have to do is grab the links in the description below, use a coupon code to grab your free 30-day trial, and you too can join us trading these momentum signals and make big money in this market no matter which direction it goes. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.